I've received a lot of questions about what caused the SVB bank collapse, and is it something that is going to spread to many other banks? Is it something that this is a political issue as of new administration causes? Is there on the news or some senators saying it was because of woke politics? I wanted to explain what happened at SVB, and then and kind of why I think after what happened over the weekend, what the Fed and the Treasury did, why I don't think that is going to be a systemic issue across all banks in the U.S. But I also explained some of the issues that face other banks. I'm not going to name any specific banks in this, but I am going to speak about SVB because they are no longer a publicly traded company. First, so to understand what happened last week, we need to go back in time, back to 2018. So back in 2018, SVB had approximately $57 billion in assets, a fairly large bank, and they're at that time a bank that's been around for 35 plus years. They dealt specifically with, well, not just exclusively, but mostly with startup companies and venture capitalists. That's who their clientele was in the Silicon Valley. They're a regional bank. They dealt with these customers for the most part. They did have individual clients as customers and depositors, but most of the assets came from the startup companies. Well, between 2018 and 2022, call it, their deposits exploded. The same time where assets really built up during that last tech bubble that we had, that's also the same time back in 2018 that the Senate, they passed a bill, the last administration passed a bill to roll back DoddFrank banking regulations on banks that held less than $250 billion in assets. It was $50 billion in assets up until 2018. So up until 2018, SVB actually had less than $50 billion in assets. From 2018 to 2022, at the end of 2022, they went from $56 billion to almost $220 billion in depositor assets, or in total assets at the firm. So that's a big jump in assets. And while most people would say, well, those are good things, and it is, but they took in way more money than they could loan out and bring in new assets. So what did they do? Well, because banking regulations were rolled back on under $250 million, or $250 billion, billion dollars, they had less oversight on the things that they were doing. One of the things they were doing, which doesn't seem so bad, but I'll explain why it is that because of that huge influx of capital that was coming in from these startup tech companies, from VC firms, so venture capitalist firms, they had to park that money somewhere. If you go back, if you remember back before the last year, Treasury bonds or interest rates, think about interest rates, not everyone follows what Treasury bonds do, but interest rates on everything from mortgages to car loans to anything else was very, very low. So Treasuries traded at near zero. We're talking very, very low rates on the short term. So you could basically make zero money going short term on Treasury bonds. So Treasury bonds are just about the safest bond you can buy. They are U.S. government-backed bonds. Well, the bank was buying these bonds. Now, hindsight's 20/20, but I don't think you didn't need to be that forward-looking to realize that those rates were the lowest in decades, or lowest almost ever in U.S. history, and that couldn't persist forever. But to achieve any type of yield they could off of any type of return off of these bonds, the bank management was buying longer dated maturity treasuries. So maybe a short-term duration treasury was yielding 0.1% or less. They were willing to go out 30 or 15, 30 years on treasuries to get 0.5%. Now, on billions of dollars, that's real money. So it's not like you're putting in $100 and you're making an extra 50 cents. I mean, these on billions of dollars, this is real money that makes a difference for the bottom line of the bank. So as they're doing that, they're buying these longer duration bonds, and the thought process, which I have to assume what was going on in the bank, is that they're bringing deposits so fast that even though these long dated deposits are long-term, not good investments, the rate of deposit they're bringing in allows them to keep making new investments. So they're basically thinking that they can ladder the bonds, they can stagger their purchases from new deposits as new money comes in. Because again, they're bringing in way more money than they can lend out. The other issue, the reason why they're bringing in so much money, is most of the customers that they dealt with didn't really have another alternative for bank. The bank, the type of bank or the type of company, these startup companies, not a lot of other banks wanted to deal with them. They didn't really have a lot of banking options because there's a lot of risk in some of these companies. So to basically get into this bank, what the bank told its customers, especially on the lending side, is that they needed to bring in all of their assets to that bank to basically facilitate the rest of their business banking. Going to now, let's go to now, the end of 2021 and the beginning of 2022. So the end of 2021, rates started coming up on treasuries, but during the last year, the yield on treasury bonds went up 5,600% in 1 year. That is a big move in interest rates. Something that we haven't seen pretty much ever. That level of move in interest rates. We're not talking about moving up from 5% to 10%. I mean, you'd think, oh, well, that's a huge move to go from 5 to 10. Well, that only doubled the rate of return. We went from 0.1% to 5.25%, over 5.25% on some of these things. I mean, we're talking a massive move in interest rates. How does that affect treasury bonds and what they were holding? So the bank was holding, so SVB was holding these treasury bonds as their reserves. They did not, on their balance sheet, do something called mark to market. So they didn't mark the bonds to what the current value is today. They marked the bonds to maturity. So mark to maturity, meaning that the value of the bond at maturity is the value that they have on their balance sheet. And that's how that change in DoddFrank that's allowed them to do that with these bonds. And for the most part, most banks do that for their reserve assets because these are safe bonds. The idea is that they're not selling them. Those longer date reserves are fairly short term. But most of the assets that they're bringing in all came in between 2018 and 2022. So when the rates were basically the lowest is when the vast majority of their investment in these treasuries came through. Whereas some of your other larger banks have been basically investing in treasuries for 30 years, putting money in there, and so they've laddered it so they don't have all of their reserve capital tied up into a 4-year span of putting money into treasuries where it was historically the lowest 4 years of return of yield on those bonds. Think about a bond in this way. Again, it's thought as the safest investment you can buy until you need to sell and the rate is lower than the current rate. So if you own a treasury bond that's yielding 0.5% and the new yields are 4%, or on the short term, actually, because we have an inverted yield curve, so short term is higher than long term. So on a short term yield, you could buy as of last week, you could buy one for over 5%. There is not any appetite to buy that 0.5%. The only way you can sell that is to sell it at a very steep discount to make up for that yield. So you have to sell it at such a discount that makes up for the yield. So over the time that you hold it, even though on the par value, so the original purchase price of the bond is when it was issued from the government, you'll get that back, but you need that's return, the difference in what you're paying versus what the par value is over 30 years has to also make up that 4.5% per year that it's losing out on. And you can imagine over 30 years or 15 years, that's a large sum. We're talking about, potentially these bonds being worth 40% or more less than the maturity value of the bond. So that is a big hit for these type of companies, or for that bank. As long as they were able to keep deposits high and did not have massive withdrawals, then it was not really an issue. SVB has been going on for the previous year with those higher rates and not having the issue. Now, what happened last week is that with their news started coming out about their reserves, more news. I mean, these are things that are in their quarterly reports, so they're not necessarily hidden, but it wasn't also well-known knowledge for many investors. So a panic started. Some venture capitalists started sharing with their clients that there's risk here. You should start pulling money out. And why did they say you should start pulling money out of the bank? Well, deposits over $250,000 are not FDIC insured. So anything over $250,000, potentially, if a bank goes bankrupt, could be lost. And remember, this is a bank that people held a lot more of their assets than $250,000. A lot of your largest banks have diversified depositors, where it's everything from the person has the small savings account up to the big businesses. Well, this bank was really catering towards those startup companies, and a vast majority of their assets in that bank came from depositors with over $250,000 in the bank. So when that fear struck, and that potentially this bank may have had a problem, these depositors started pulling money out very quickly. When I say quickly, I mean like $45 billion in 2 days. Huge amounts of money in a very short period of time. The news didn't necessarily help, but they're not, the news is there to sell commercials. Remember, when they're just showing you videos of people standing in line outside of a bank branch saying, I'm waiting to get my money, like it's It's a Wonderful Life run on a bank, that is really unrealistic, because anybody who's walking into a bank branch trying to pull cash out has most likely less than $250,000 in the bank. Number one. Number two, a bank doesn't hold that much cash in there. A company like Roblox that had $150 million deposited at SVB, they're not walking up to the teller and be like, I want $150 million. That's not how that works. They withdraw money by moving it to another bank. So that's what was happening. They were just going online, going to their bank, doing a wire transfer of money, of assets from that account to another account. Most of these people had other accounts somewhere else, or it's fairly, for a business client like that, you could open up a bank fairly quickly. Bank account. So That happened in a very short period of time. By Friday afternoon, the bank regulators came in, looked at what was going on, that if the withdrawals continued the way they were, the bank was going to run out of assets to be able to pay the depositors very quickly. They already started having to sell reserves at a loss. The first reserves they sold, they lost $1.8 billion on the sales, and I'm not exactly sure how much those bonds were worth at the time. But depending on when they were purchased, I mean, that was still a fairly massive loss that they're selling bonds to cover withdrawals. Again, just off the stuff they sold before the bank was shut down by the regulators, lost $1.8 billion. So the banking regulators came in, shut down the bank, basically halted all withdrawals, and from Friday afternoon till Saturday afternoon, tried to find another bank willing to go and buy that bank's assets and liabilities, basically take over that bank. Somebody else want to acquire this bank. Again, I'm not going to name specific banks or anything in this, but other banks looked at them. Other large and regional banks looked at buying out SVB. After they looked at the risk tolerance that they were willing to take on it, and at that point in time, no bank was willing to take on the risk of taking on the SVB depositors and their treasury bonds as a liability into what would end up being a liability into their portfolio. So it was stuck where there was no buyer left to come over and take over the bank. That would be the best option that the Fed, the banking regulators were looking for. So then they had a hard decision to make. What do we do with this? Because there's such a large amount of uninsured deposits at this bank, how do we proceed? At that same time, Signature Bank in New York started having problems. I'm not going to go into everything with Signature Bank. Signature Bank was a bank that dealt with a lot of crypto investors and crypto clearing firms. So they had their own specific problems, but they were another bank that had a similar makeup to SVB. So they were also at the brink of collapse, to the point where the Fed came in over the weekend and shut them down as well and took them over. Now, when these things happened, that meant both of those banks, their equity holders got wiped out. Their bond holders got wiped out. Not people who have investments with the bank, people who invested in the bank. So people who are actually invested in those stocks, those people got wiped out. Which is a big difference than what happened back in 2008. So they looked at this, okay, that run on that bank would not have happened without the run on this bank. And they looked at the other range of banks that have similar issues, not quite as egregious as SVB, but other banks that have the same problem, and say, what's going to happen? Well, that money doesn't just go into somebody's mattresses. If you have $150 million at a bank, you don't take it out and then put it in mason jars and dig holes and put them in your backyard. That's not what happens. The money just flows to another bank. And what banks does it flow to? It flows to the top 4 or 5 banks in this country. We don't, so if we're going back to 2008, 2009, and the bank bailouts, because they were too big to fail situations, we don't want another too big to fail situations. And if all money starts coming from smaller, local, regional banks, and then all flows to these large banks, now what you basically have done is that you wiped out the regional banking in the country, and you have the largest banks that acquire all the money. And on top of that, you risk the FDIC insurance fund, because you could have a massive amount of smaller regional banks that all have depositors that would need to get covered by FDIC insurance. Didn't want to see that happen. So how do they stem that problem? You have to do the best, worst decision, which was they decided to go in and guarantee all of the deposits over and above $250,000. The question is that a moral hazard on that? Is there a big moral hazard on now doing this? Well, remember that the equity at the banks was wiped out. So the manager of the bank, they lost everything. The bank is done. It could get bought out, but still the equity shareholders are done. So this doesn't lead to a bank becoming more, excuse me. It doesn't make a bank become more risky because the risk that they're taking still wipes them out. So it's not the moral hazard. And from the depositor standpoint, you're already dealing with companies that really don't have a choice but to hold assets somewhere else. These are not, if you have $150 million you need to park as a company, you don't really have the option to spread that out over $250,000 accounts. I mean, that's not realistic. There just isn't enough banking that can handle that, and that's not realistic for a company. So I think they did the right thing. I not only do I think I believe they did the right thing here. They guaranteed all those deposits. It makes the banking sector feel safer, so people do not have a run and start moving all of their money out. The person that's taking their $5,000 out and putting it in their mattress, I'm sorry for that person for not understanding how banking works, but that's not something that anybody should be doing. But it did stop a rolling issue or a domino effect across other small and medium banks. Was it going to bankrupt the country is the same as the financial crisis of 2008, 2009? No, but what would happen is that all your largest banks would end up with trillions of dollars of new deposits, and your smallest banks would go out of business. Different than what we had before, which is the largest banks that had all the deposits and had mortgage issues, now being in a position where those assets are, those banks were going to go out of business then. Here we're not talking about the largest banks going out of business, we're talking about the smallest ones and all those funds going to the largest banks. So what they did is the right thing. I think if anybody who's saying otherwise is using it for some type of political reason that's probably not in the best interest of this country on either side of the aisle. But so what happened is correct. Would it have happened if they didn't roll back the banking regulations in 2018, the DoddFrank Act that was initiated after the financial collapse? It's not guaranteed that it would happen. It's not guaranteed that it wouldn't happen. So I know it made it easier for it to happen because you had less regulation on and less oversight of these banks. But it's not as if, looking at what they didn't take on risk like similar to the housing crisis and the banking issues that we had in 2008, 2009. It wasn't about buying subprime loans. They had a portfolio of the highest credit quality, highest credit quality debt you could possibly have, which is U.S. Treasuries. Unfortunately, they went out long term with a lot of money in a very short period of time. So they bought them all at the lowest possible rate you could buy them at, and then rates went up exponentially over a very, very short term that no one's that in recent or no history have we seen that type of move in Treasury bills happen to that speed. And they got caught on the very wrong side of that trade, and it caused a lot of problems for them. So looking at all those things, this is what happened. This is why I don't think this is something that is a systemic risk throughout the entire market. We had another foreign bank, again, I'm not going to name the name today because it's still traded, but another foreign bank that has U.S. holdings, but it's not a U.S. bank, that had their own separate issues. The government, who is named in the title of that bank, said that they are going to back them. I don't think that there's going to issue that, but that specific bank has had problems since the financial collapse of 2008. So they've had rolling issues for years. It just, more things have come to light because of this that happened, and then another foreign government who did invest in that bank said that they can't add any more money to it, mostly because it hit a 10% threshold where they couldn't add any more by regulatory reasons. They weren't allowed to add any more to it. It wasn't that they even said that they didn't have any more faith in the bank, just but if they added more money, they'd become over 10% shareholder in it, which was against the regulation, what they're allowed to do. So I hope that explains some of what's been going on. I know there's been a lot of very, very bad information. Some of it is just, they're trying to fit in all this information into a news story going through for like 2 minutes, and you can't explain all this in 2 minutes, obviously, by this 25-minute conversation that I'm having here. But it is something that everyone should have a little bit of an idea on, and I didn't go into super depth on everything here, but it gives you an idea of what happened with the bank, why I don't think it's something that's going to be systemic, because since that implied guarantee from the government on deposits over $250,000 came in, the withdrawal rate on these smaller banks from clientele has slowed down. Not that it's been eliminated. You still have money that's flowing into these largest banks from the smallest ones, but it is not, we do not see the run like we saw on SVB on last week, or even with Signature Bank over the weekend on Friday and Saturday. So that is why I believe this is not something that is going to then be a long-term or a vast issue across the entire banking sector. Banks have gone bankrupt before. I mean, we don't always follow them, but because they're not as big in the news. But we're talking about, these are things that do happen. Banks go bad, that take on too much risk. We have not seen a bank go bad in 2 years, but during the beginning of the pandemic, we had banks in the Midwest that went bad because they were tied to the energy industry when oil went from $70 a barrel down to zero, and these were tied, so they had a lot of loans there. Now they didn't have the same issue of having their reserves being worth a lot less because of it being in treasuries, but they had a lot of loans that went bad. Similar to the housing crisis, all things that happened very quickly, and those banks went under, and they were acquired by other banks. But it is not uncommon for a bank to go bad. This one, they say this is one of the largest in history since Washington Mutual. Yes, it is, but it is also, you have to understand the difference in size between the 16th to 18th largest bank to the top 4 banks. It is a huge difference in valuations, in deposits. And the largest banks have a much more diversified deposit base. They have a lot more clients with less than $250,000, people that wouldn't be pulling out. You have banks that are also brokerage firms that have deposits, and those assets are much stickier, do not move as quickly. So again, this is not something that I feel is a long-term issue. It is riling the markets now. People are selling first and asking questions later, but I just want to explain what's going on, and this is not a recommendation on buy or sell anything, just what is going on, and I hope everyone learned a little bit from it. These are the kind of conversations I have with my clients and explaining what's going on and why I do the things I do in their portfolios. Well, have a good evening, and I hope you learned something from watching this.